So with that, we'll get started. Welcome everyone. My name's Steve Wildman. I'm Vice President of Planning here at Diversified. Thank you again for joining us, and thank you as always for your trust. We have a lot to get to today. It's the beginning of Q2 and of Q1. And as always, there's a lot to talk about, especially in the beginning of the year. It's tax season. We've had a quarter under our belt in the markets and performance. So we'll get to that shortly. Like I mentioned, we'll review Q1 results, give an overview of where our economy and markets stand, given a lot of the recent geopolitical events and conflicts around the world, most notably, as we all know, the war with Iran and the impact that has had on the markets. So we have around 25 minutes of planned content for today, and like I mentioned up front, if you do have any questions, we'll have a 10 to 15 minute Q&A session towards the end. So if you have any questions, there is a Q&A button at the bottom of your Zoom screen that you can submit any questions that you have now, or like I mentioned, throughout the session here if they come up. So with that, I'd like to introduce our investment expert and speaker for today, John Cahill. So John Cahill is a investment analyst here at Diversified, where he supports portfolio management, market research, and investment strategy. He works closely with our entire investment committee in helping deliver disciplined, long-term investment solutions aligned with all of our clients' goals. John earned his bachelor's degree of science and BA with Delaware Valley University and later pursued his MBA with Drexel University here in the local Philadelphia market area. He also holds his certified financial planner designation. Prior to joining Diversified, John gained experience in financial planning and investment management roles at Gerard and Crossgate Wealth Advisors. He lives locally here in the Philadelphia area in Langhorne with his wife and two children. John, like he mentioned before, he just dusted off his clubs. He enjoys golf, time down at the Jersey Shore, well, I would assume Jersey Shore, and also cheering alongside me, Philadelphia sports. So with that, John, I'll hand it off to you. I'm going to turn my camera off. And just a reminder, folks, if you have any questions that come up during the session, please use the Q&A button at the bottom of your Zoom. So with that, John, I'll leave you to it, and I'll be back in a little bit.
Thanks, Steve. And thank you for the introduction and welcome everyone. I'm glad to be here with you. And as Steve said, right, this quarter certainly had a lot of noise throughout the quarter. And as a part of our theme, as we always like to do, the theme this quarter is around weathering the storms. And the storms this quarter that we're referring to is the market noise that we've seen over the past quarter. Just kind of moving to the first slide, and really what I want to kind of explain or just show is noise is normal, right? The storms are a part of the forecast, right? If you look at 5% pullbacks over the market history, you'll see the average is about 4.5. And what we've seen so far this year in Q1 has been 5% pullback. So we're really right on average to hit kind of that normal volatility that you see in markets. I think it's important to just set the stage a little bit of what has occurred and why we've seen kind of the pullback in markets, as Steve alluded to, right? The big one is the conflict over in the Middle East. But there has also been kind of some other storms or noise in the markets that we'll touch on. I think the big thing too to kind of keep in mind is what is the actual backdrop, and we'll go into that a little further in detail of the storms or the noise is one thing, and that's kind of the why that we've seen markets pull back. But it's important to kind of get an idea of what the underlying kind of broader economic conditions are that support kind of what we've seen. So just kind of switching to the returns by the asset class, we've seen kind of global stocks be down 3.2% year to date through the first quarter. And really a large part of that came in really the last 5 weeks of the quarter. So if you think about the quarter into two sections, we had, from January 1 to about February 26th. That was kind of the start of the conflict. We saw international off to the races again, up double digits or close to double digits for that first half. We also saw small caps slightly behind, up about 8% during that first half. And the S&P 500 was essentially flat, up about 1% during that period. What we saw the second half or the last 5 weeks was really a reversal. And I think it plays into some of the underlying indexes and the numbers that you're seeing. So we saw both the international indexes end down for the quarter when they showed really kind of robust earnings or growth in that first part of the quarter. And really that has to do with what we're going to touch on in a little bit with the conflict. But it also shows kind of the resilience in the domestic market. As I mentioned, right, the S&P 500 was up about 1% in that first half, finished the quarter down about 4%. It was the best performing asset class over the last 5 weeks. And, I think that speaks to investors still having a view of stability within the U.S. We saw the dollar as measured by the Dixie increase, where last year, and it supported some of the international earnings, international performance, and even to the first half of this year, the international performance. A catalyst of that was a weakening dollar, and we saw that reverse as the conflict and volatility picked up, where the dollar started to strengthen. The domestic large cap companies held up better than its peers over in the international market, as well as even the small cap space. Even though the small caps, as measured by the Russell 2000, they were the only positive equity index for the quarter. When we look at the flip side, and the fixed income market within bonds, and just looking at the aggregate bond index and the municipal bond index, right, essentially flat for the quarter, down slightly, right, 0.1% on the ag, 0.2% on the muni bond index. And really to us, that's just showing kind of the stability or the ballast that bonds tend to be, right, the anchor in the portfolio. So both of those both of those indexes kind of perform the way we would expect them to during periods of volatility, and they've been kind of a key part to portfolios within Diversified. So as we turn to kind of that first storm, or kind of the first kind of headline or noise in the markets, right? It's around everything that is going on over in the Middle East with the conflict with Iran, and really what I think this chart does a great job at showing is there are short-term volatility, and that's normal. And really, the next chart kind of plays into this chart as well. The next chart focuses on oil and how oil behaves, especially when we have a conflict in the Middle East. But what we tend to see is, what conflicts tend to do. Short-term volatility increases because, right, it brings a level of uncertainty, and markets tend to not like uncertainty. They like things to kind of stay status quo. But what we see is when you go 6 months and a year out, the noise starts to not be as important, and markets and investors start to really turn their attention back to kind of the things that matter, and that's earnings and the broader just kind of economic backdrop. On this chart, the two exceptions to that, obviously in 2022, when Russia invaded Ukraine. In 2023, we were still kind of recovering from one of the most aggressive rate hike cycles of the Fed. Um, and then back in 9/11, we were still in the bear market during the dot-com bubble. So outside those two exceptions that were really more driven by the underlying economics, what we tend to see is positive performance as you get further out from the conflict start date. Um, the other thing that I mentioned was how the primary kind of impact on the geopolitic conflict is oil prices, and we have certainly seen a whipsaw not only in markets um, but also in oil prices. And if you see that it tends to follow a similar kind of cadence. Just with the Ukraine war, we saw a spike in oil prices above. We also saw that um, occur recently, and we've seen it really swing from over $100 to under $100. It's been really uh, tough to keep track of. It seems like every day there's oil prices are doing something, and we've even seen that in the broader markets. Um, Yesterday, when we look at the performance, right, the announcement of the ceasefire, we saw markets rally on that news. And today we see a little bit more of a muted kind of return so far, and that's really around the uh, the news of kind of the finger pointing of both sides breaking the ceasefire. I saw one of a UAE CEO, oil CEO, say, the Strait of Hormuz is not open, and they're not letting free passage through, and that does bring a level of volatility, and that's one of the reasons why we saw that volatility within oil markets. The Strait of Hormuz is a pretty critical passage, especially for Asian markets. So it kind of explains why we saw emerging markets performance since the conflict happened be kind of the worst performing index. They receive about 80% of their oil and liquid natural gas through the strait. And really, once when this conflict started and the passage was essentially closed, what we saw was um, what we saw was um, you know the um, emerging market index is really kind of pull back. So that's just something to keep in mind, that even with the oil and the conflict, there are some that are more insulated and others who are affected more. So the U.S. is a great example. We have become relatively energy independent, rely on oil from kind of the Middle East a lot less than what we have before. So, I think that's another reason why we saw U.S. markets hold up a little bit. Now, global prices are going to be dictated by what's happening in the global oil market, but the actual um, price or our ability to produce oil, we no longer rely um, over on the Middle East as much as Asia, as the Asian countries do. So I think those two things are important to keep in mind as this conflict continues, and it's something that we are going to continue to watch on our end. Um, the next big storm that we've seen is around tech and AI. And 2025, if AI was a tailwind, right? What we saw was AI companies be rewarded. They were kind of leading the charge in the index. That's why we saw such a concentrated index, and that has really changed. Investors have started to view um, kind of the AI side of the trade a little more bearish, in the sense of now what they're trying to do is pick out who are the winners and who are the losers, and we've seen that in some of the services and software names. There was a period throughout the first quarter where we saw litigation or legal services stocks be down. So LegalZoom was down, I believe, around 50%. We saw that through consulting companies, Accenture being the large one, down 30%, as well as financial services companies. LPL kind of pulled back, was down about 10% on news of AI tools being able to um, help and essentially take take jobs away from the industry. What this chart does, which I think is great, is it shows the theoretical, essentially where AI coverage could be, but it's actually shown where AI is showing up today, and obviously where it's showing up today is a lot less than um, theoretically where it is, and that's just part of that is adoption rate is tends to be slower. Um, but again, we also view AI more as a tool of productivity rather than a replacement of jobs altogether. And this is really what this chart is showing is the stock market and essentially innovation. So what we tend to see over time is innovation is nothing new. It happens in the past, and it will continue to happen. And what we tend to do is, right, we find ways to be more productive as employees, and we also find companies that are the winners and the losers, and the market resets, but they continue to move forward. And we believe this is no different. The AI is no different than the internet era, or even if you go back to the way railroads kind of changed how business was done, as well as vehicles. It's going back to kind of the basics, and at each step of the way, what tends to happen is productivity increases. Jobs that are lost tend to be replaced with higher paying and um, better positions, and we tend to move forward. So we don't see kind of AI being the necessarily the kind of the replacement of individuals or jobs at large scale. We view AI as a productivity tool, the same way that Microsoft Excel, when that was first um, brought to the market, was really a tool to enhance productivity. Um, we don't believe that that changes with AI, and the employment side of the picture is still telling that story. Software engineer positions are that's still one of the most you know demanding jobs out there today. Um, so the whole idea that software and engineers are going to be replaced completely, we just don't see that. We even see it on the earnings side. Software earnings are continuing to be double digits, and the projections are still to be are still strong in the future. So we even think companies like ServiceNow and Salesforce, who have underperformed because of the idea that AI is going to replace essentially their business model. We just we don't believe that. We believe these companies are going to integrate AI within their systems to better their product. And then the last storm, and really this is a combination of the first two, but it's around consumer sentiment. What we've seen with consumer sentiment recently, and it's really tied to um, the geopolitical conflict, is we've seen that consumer sentiment come down to levels that we haven't seen since 2025. But the big thing is the expectations are really only for the next 6 months that have come down pretty significantly. If you look at the expectations over a year, they are still elevated and higher, meaning that even consumers see what's happening within their own kind of situation as temporary. Um, and one of the key things from the past, right? It was always this K-shaped recovery. Higher income households have also kind of declined in sentiment. I think what we've seen is a little different than how people are feeling, right? This is kind of the soft data side of it, where this is how people feel right now. The hard data kind of tells a different picture, and the CEO of Bank of America, Brian Moynihan, came out recently and said kind of the same thing of, consumers are saying things don't feel great right now, but they've seen an increase in spending on their own uh, product side. They're seeing consumer balance sheets still be strong. So what they're feeling in the soft data and what's happening in the hard data they're telling two different kind of stories, and this kind of changes really the concept from the storms, right? The noise in the market to what we call the climate. And really this is based around, the La Nina and El Nino kind of underlying um, pattern, so to speak. And we kind of tie this to what is the broader economic pattern. And right, it starts with the consumers. Consumers make up close to about 70% of GDP at this point. So consumers are, front and center, one of the most important kind of measuring sticks of economic growth going forward. And what we've seen is spending increase as Brian Moynihan has said, and we see in this chart where right retail sales are going up. Consumers are still spending. A lot of kind of the downturn that we saw in the first half of the quarter. A little bit of that is weather related, ironically enough. But on the flip side, not only is the consumer spending, but we're also seeing the household net worth reach the highest levels since 2020 and exceeding that. Record household net worth levels for U.S. consumers. So the consumer remains strong from a balance sheet perspective. They remain strong from a spending perspective. Um, and as long as that stays intact, uh, that's going to lead to further growth. And obviously everything that is happening specifically in the Middle East could have an impact on that, and that's something that the investment team we're keeping a close eye on, along with the other climate pieces that I'm going to go through. But the big thing is, right, the consumer remains healthy, the consumer remains strong. Earnings, right? This is another big one. If we look at S&P 500 earnings, um, we're on track for a sixth quarter. So that's going back, almost a year and a half of double-digit earnings growth. So to say, U.S. companies remain their earnings remain robust, and they remain on solid footing. The big thing, and this has kind of been the story since 2025, is right. A lot of the pressure, still is still on the technology sector, and technology, especially kind of the Mag 7 names, they're always under the microscope. But everything that we're seeing and we're reading is that positive growth is going to continue on that side, as well as the capex spending side. The Fed and monetary policy, the Fed is in a very difficult situation. We just had a new inflation number print come out today. We actually seen the number come down, ironically enough. But we we know this is important, right? Because inflation, even though it's not showing up today, if the conflict kind of continues, where oil prices remain high, that kind of trickles down into the business input side, and then ultimately is passed off to consumers. That is something where, um, we just have to be aware of, and something that we're watching. But it's a tough position for the Fed to be in right now, because and on one hand, right, they're watching the employment situation with strong job numbers, and then unemployment kind of level still at historically low levels. But they're seeing inflation seem to be a little bit more stickier, right? They still haven't hit the 2% um, consumer price index target that they're shooting for. Um, and really, what it seems like is they're in a wait and see moment right now. To At the start of the year, essentially the market was pricing in about 1 to 2 additional rate cuts. After the second Fed meeting not too long ago, markets are now pricing in about a 25% chance of just one rate cut for this year. So it's a changing situation, especially with the Fed on the rate cut side. The one thing that I would say is positive is they have become more accommodative on the balance sheet side. So what we were seeing really from 2022 and as of recently is this QT, or quantitative tightening. And basically what they do is they're trying to shrink their balance sheet, and they just let investments run off. What we've seen happen is they're being more accommodative on that side. Not where we would say it's QE and they're pumping liquidity into the system, but they are at least keeping their balance sheet kind of where it is currently. They're no longer trying to shrink their balance sheet. So it's another lever that the Fed has to be able to pull. But it kind of paints the whole picture of, they're in a tough spot with everything going on with the conflict and the employment numbers. For fiscal policy, I think this is the biggest tailwind for consumers. And man, is it coming at a pretty good time for consumers. Um, and this is really around um, kind of the tax incentives and um, business incentives that came out of the one big beautiful bill. Um, Really, what is expected to see, and Wall Street's estimating about $170 billion as a result of this, is consumers should be keeping more money in their own pockets with the federal tax refund. So, the expectation is that's going to continue to keep kind of that consumer spending engine running, and also be able to offset any pressure that they do feel on the inflation front from the oil and energy side. So really, that's one of that we look at as one of the big tailwinds of this year is on the fiscal side. I think tying it all together, I think it's important to look at that, right? The storms or the market news, they tend to be short term, and they tend to always occur, right? There's always something. In 2025, it was the tariffs and Liberation Day, and to start 2026 in Q1, it's AI and software and the conflict with Iran. And what's important to keep in perspective is what the underlying kind of climate or the underlying broader economic conditions are. And right now, the consumer remains strong. Earnings still remain robust, and earning projections are showing growth. And there's that fiscal tailwind to help. With all that being said, kind of looking at the asset allocation picture or positioning that we've taken, a lot of it has remained the same, right? We've kind of taken a more quality tilt to our portfolio back in 2025. And on the fixed income side, introduced a tips position to kind of counter counteract or be able to just kind of manage kind of the inflation risk that we saw that could be out there. The one change that we did make was increasing our emerging market exposure. And to specifically kind of speak to the change that we made, we were in a semiconductor ETF, had more of a U.S. domestic kind of growth tilt within our portfolio. Um, it's been a great position for us. It's been in the portfolio for a while. We kind of knew that that trade was played out, and we rotated that into the emerging market sector, and it's really an extension of what we were doing. Right, this isn't that we're not bullish on U.S. or the AI trade. We still remain overweight to the U.S. For the or for the reasons I mentioned before. This is really an extension of that AI trade playing out over in the emerging markets, specifically in the Asian company or Asian area countries with Taiwan Semiconductor, as well as some over in Korea. They have the hardware and both the software side of the trade. So what we've seen is that has played out into earnings, and that's what this kind of chart shows, that earnings growth expectations, especially in emerging markets, is really set to grow. I saw a chart through BlackRock, and they showed EM countries or EM companies within the AI sector were expected to see earnings growth of close to 50%, and the hardware side was going to be around 30%. So that is starting to play out. We've seen that play out last year, and we felt like it was a good time to kind of rotate out of that position and kind of catch the broader AI trade. And then just real quickly, some of the portfolio winners. This is really value was the Q1 winner. And that's why we highlight the small cap value fund that we have up 6.67%, while the index was essentially flat. And then our Pzena Emerging Markets Value Fund up 4.5% year to date through Q1, while we saw the EM index be down. The new international EM position that I was just talking to, SEAM is also up 5% year to date. And then again, that TIPS fund really being the highlight of Q1 in our fixed income portfolios, being up while the index was flat. So before I wrap things up, I know I've been talking for a while. The last thing I just want to say is, typically during periods of market stress, it's very easy to let emotions kind of want to make you do certain things to the portfolio. I think the big thing that we would recommend is when you have kind of this market volatility that's making you uneasy, I think it's a great time to call your financial advisor at Diversified and take a look at your financial plan again. And I think that really will tend to put you in a good perspective of where you're at today. And maybe the plan says you can take some risk off the table, but just know that when we build our plans, we're building them for times like these. We're stress testing the portfolios, not only through the good times, right, but through the down times as well. So I will open it up to Q&A. I'll turn it back over to Steve.
Yeah, thanks, John. Great stuff. And you didn't disappoint. There's a lot going on, so appreciate you running through your thoughts and the thoughts of the entire investment committee here at Diversified. And great advice at the end. If there's any questions that we don't get to here, or if anything comes up after this webinar, feel free to reach out to our investment team, to John himself, myself, but most importantly, your financial advisor can certainly take the information or the questions you have and relate that back to the financial plan here at Diversified to help answer any questions. So with that, John, we do have a couple Diversified. We have a couple questions here for clients of Diversified. First one Let's make sure I got it here. First one's a good one. Speaking of client or investor typical behavior, right? What mistakes in your mind do you see investors make in environments like this?
Yeah, that and honestly, it's going back to that chart, right? Of staying invested during um, periods of volatility because of missing the best days, what that can do to a portfolio, and that's typically right. The big thing that we see is, or the questions we get is, should we take some equity off the table? And really, doing it at this time, I think yesterday is a great example of this, right? Who would have saw, the 3% move coming? It's just so hard to handicap situations like this that, the best thing to do is, to realize that one, we've built the portfolios to have this quality tilt, to try and, really out outperform on the downturn or perform well through a full market cycle, that we're really not going to try and make really move into a position or move out of a position, based on something that's happening that we see as short term. So that would be kind of the one thing we tend to see the behavior side of finance take over, and for us it's, let's just take a deep breath, let's take a step back, let's look at kind of what is happening in the underlying economic backdrop and what's happening in with the consumer, and how does that relate to the portfolio.
Makes sense. Thank you, John. Next question. So this one comes from Stephen, who spells his name the proper way, in my mother's opinion, with a PH. Um, so the question is, how is Diversified positioning client portfolios to participate in long-term growth opportunities created by artificial intelligence? And where do you see the most durable ways to gain exposure to AI?
It's a good question. I think the big thing to realize is a lot of these public companies that you're investing in, they're already investing a ton into AI, right? That's the whole capex spending that we've been hearing about now for I feel like it's been a few years now. So I would say, you already have exposure to AI. Um, it may not be in necessarily the end kind of user AI, like a chat GPT or something of that nature, but you're getting exposure through, right, the picks and shovels companies, or we still have exposure to Taiwan Semiconductor. We still have exposure to the alphabets and the metas of the world that are investing heavily into artificial intelligence. So we're playing the AI kind of picture or theme. I think what the change we just made, the increased EM, is a great example of that, of just trying to broaden out our exposure, and that you're going to pick up exposure through AI, even though it may not be through, right, an Anthropic or one of those names.
Understood. Next question from Andrew. Downturns are times to invest more, typically. How often does Diversified rebalance portfolios to take advantage of these periods?
Yeah, it's something that's a part of our process, and we look at. Um, I know we were proactive in April of last year, or in Q1 of last year, taking advantage of that downturn, which was a little bit more of an aggressive pullback than what we saw so far this year. But we just did a rebalance in the portfolio, right? When we went and made the change, right? We're going to go in, we're going to rebalance. I would say it's certainly a part of the process, and certainly something we also like to take advantage of is, when markets really dislocate. to try and come in and rebalance portfolios.
Understood. And last question I'll address here, John. So the last question here was the return on the assets for diversified. And what I would, and this person is submitted anonymously, and what I would encourage this person to do is if you have questions on whether it's your own personal portfolio or portfolio returns of the diversified models, certainly reach out to us so we can provide that to you because there's nuance to that question that we don't have time to get into here on this webinar. So. John, that is all the time we have, and appreciate you answering those questions and appreciate you running through the materials that you had. Folks on the webinar, thank you as always for attending these sessions. We certainly appreciate it. And like I mentioned, if you have any other additional questions, please reach out to your financial advisor here at Diversified to go over those questions or reach out to John or myself, and we can facilitate that conversation as well. As always, thank you for your trust in what we do. We appreciate you all, and we hope you have a happy and healthy spring season. Thanks,
Take
everyone.
care.